Okay, welcome to the weekly S&P 500 chart storm run through. So for those who are not familiar, this is basically 10 charts that I post on Twitter every week. It's a big mix of anything from technicals to seasonality to fundamentals to longer term stuff, a bit of esoteric things from time to time. And the purpose of this video is basically just to I'll go through each of the charts, blow it up a bit, and just talk through what thinking about it and why it stood out to me. Um, I guess first of all, the purpose of the chart storm isn't necessarily to come to some, or to lead the reader to some, you know, preconceived view that I have that I'm trying to get everybody to come around to. It's to present a selection of interesting charts. And look, sometimes, depending on what's happening in the markets, they're all actually supporting a particular view and there is an actual conclusion. But other times here's a bunch of interesting charts and here's a couple of common themes and takeaways. And if we do have that, I'll outline those at the end. And then just finally, in terms of how this video works, I haven't scripted it or anything. This is a pretty free flow, so it'll be a bit rough and ready. And that's probably enough explanation. Let's get straight to the first one. So I'll read out the tweet first. Alternative view of volatility for the S&P 500 looks to be turning up from a low point. You know what that means. And I don't know if most people actually do know what that means, so it's probably a good time to actually talk through that. So first of all, what are we looking at here? Black line, obviously that's S&P 500. It's on a log scale, just because otherwise it would just look ridiculous on a long-term chart like this. The red line there is so this is a daily chart, first of all. So this is a rolling 12-month count or sum of daily percentage changes which exceeded minus 1%. So for example, if it was minus 1.2%, it would be included, and positive 1%. So if it was plus 1.1%, it would be included. If it was 0.99%, it would not be included. And so it's basically another version of volatility. Being a 12-month count, it's a little bit more smoother than, say, for example, a rolling 20-day count. In terms of its use as an indicator, it's just another sort of way of characterizing historical price behavior. And, a lot of the time you can kind of get a little bit of a read on the next steps in the market based on the historical trading behavior or price behavior. And I'll give you a couple of examples of that. So first of all is probably looking at whenever you look at an indicator like this, it's always looking for the extremes, and because most of the information tends to be at the extremes. So we'll look at the spikes first. As you might guess, you get spikes in this indicator most often, but not all of the time, most often when markets are in turmoil. So for example, back here, you've got a spike there when it's rolled over into a bit of a bear market or crash. Same thing there, another one there. We'll go for the another one there, 87. Another one there in the going into the 2000 bear market there, 2008 episode there. The smaller sort of mini bears or corrections in the post GFC period, the monetary policy, the age of monetary policy, I guess you could, or the golden age maybe of monetary policy. And then there's a couple of times where you do get higher volatility in the situation where the market wasn't actually crashing. So for example, in the looks like about 1980 there, but probably the best example is the late 90s, where you had this pickup in this indicator that kind of persisted and then climaxed at the bottom of the market there, the end of the bear market. And that's another point there, is when you get the climax, and that tends to be the signal. That's oftentimes when you get indicators like this, you get this sort of climax, extreme, and then it comes back from that, and that tends to be the signal. But I would say that, outside of a crash or bear market, these spikes, you see it during a more frenzied bull market, which was probably what we could call the late 90s. So that's useful and interesting to think about, that we're actually in the middle of the opposite of that at the moment. So we're in a period where this indicator has actually fallen to a low point. And, again, and similarly, there are exceptions, but we'll go through the kind of the rule first before we go to the exception. And that rule seems to be that when you get very low readings of this, it's oftentimes around a market peak. So back there looks like about 68, there 1970 looks like, and where's some other ones there, 80, looks like 89, 90. And again, you saw it trough for a couple of years, and then it seems like the kind of low point there before it started to turn, and that's an important preface there, was about 2007. And then again in this sort of golden age of monetary policy, post-GFC period, there was a couple of times there where a trough in this indicator and a turn up was very close to a market peak. So very much like a contrarian indicator. If you get spikes in this, typically it's at the bottom of the market. If you get a trough and it turns up, it's oftentimes, not always, as we can see, there's actually quite a few exceptions there. That can be a warning indicator. And so at the moment it looks like it hit a low point, not at the very lows that we saw in 2017, but it looks like it's hit a low point and kind of started to rebound. So maybe that is a bit of a warning indicator. Of course, it's not, there are some chops in it. So for example, we can see there looks to be about 2004. There was a lot of little rebounds on the way down, so it could be just a case of that. It could be a little bit of a rebound and it carries on going down. Not one to be like the main signal, not certainly not going to be the main driver of allocation decisions, but certainly one to keep track of. On to the next one. Speaking of volatility, here's a more familiar measure, the VIX, and its average seasonal map, and also against the S&P 500. So this is by business day. For the VIX, it's the average reading across that time period. And so really just that's, this is kind of giving you a generalization based on the data across that period, so the last 30 years. And generally, the VIX tends to trend down from during the first half of the year, and generally it tends to run up towards October, tends to climax around then, and then kind of tends to trend down after that. There would probably be some people saying, well, hang on a minute, October, that was kind of when GFC 2008 really kicked off. Is that just going to be skewed by that? Certainly would be, but then I've looked at the data, looked at it without that. If you exclude that, and you still get the same kind of pattern. Kind of lines up with what you're seeing on the flip side there. So with the S&P 500, so this is based on daily percent change. You tend to get this seasonal tailwind in the first half of the year. Then you get that sell in May effect, or I guess it looks more like sell in June, and come back in October. And yeah, basically they look like mirror images of each other, which is kind of what you expect. Um, based kind of like what we saw in the previous chart, the VIX tends to trade inversely to the S&P 500, just as other measures of volatility kind of tend to as well. So, does that mean that stocks are going to go up from February to June, July? Possibly, but seasonality is kind of, I always consider it the last thing you look at. So, you go and do your homework, you build your case, you do your analysis, and, you know, you'd be relying on sort of more robust indicators. And then you'd look at seasonality at the end, and if you're looking at like 10 different things and 8 of them all said the same thing, and then you look at the seasonality chart as your 11th chart and it's also saying the same thing, then you tend to have put a bit more stock and faith in it. If you were looking at 10 different charts and 2 of them were saying one thing, the rest were saying another thing, and seasonality aligned with those 2 things, then maybe you'd have a bit less confidence in it, or you'd put a little bit less weight in it. So it's kind of useful chart to have because it's quite timeless in a way, and gives you a bit of a map for how markets have tended to play out across that time. Of course, again, as I've alluded to there, it's the averages, and the average can deceive because there can be wild variation around that. Number 3, kind of another seasonality kind of thing, or at least historical averages. So the S&P 500 was down marginally in January, minus 0.16%. I mean, I pretty much would call that unchanged, although it was down from where it got to, so maybe that's, you do call it down in that sense. But anyway, does that qualify as a down month for the January effect? Here's the historical average playbook, if so. So I'll blow the chart up there. The January barometer. So the thinking here, or the point of this chart is, if January was higher, the green line shows you what happens next. If January was lower, the yellow line shows you what typically happens next, what happened on average. That's all we've kind of got in this chart. There's no more stats beyond that, but basically the takeaway there is that if January was lower, then you tend to get more of that. If January is higher, you tend to get more of that. If January was unchanged, or very littly moved like we saw it, I'm not sure what that looks like. I'd have to rerun the numbers. Well, this is not my chart, but I'd have to go and look at the numbers. I might go and do that later actually. But yeah, I mean, being such a hardly moved number, such a small percentage move, I guess there is a little bit of debate about whether you would strictly call it one or the other. So I'll leave it at that, and I'll leave you to ponder and debate about that. Number 4, rational expectations or irrational expectations. Let's look at the chart. So we've got here in the blue line the probability of increase in stock market in next year, and so that's the survey question in the consumer sentiment survey there, and that's the mean average percentage response, and it looks like folk are fairly bullish on the market. Looks basically like a picture of the price. If you put them over each other, it kind of looks very similar. And price tends to have a very big impact on sentiment, but then price also reflects a lot of what's going on elsewhere. So price tends to be higher when the economy is better, and price tends to be higher when monetary policy is easier, and price tends to be lower when things are going bad. And so you'd expect consumers to kind of be looking out the window and saying, how do I feel? Feel good because the market's up, jobs are good, economy's great. So you'd expect them to be fairly bullish. I mean, yes, it's kind of the way the question's asked is an expectations, a forward-looking thing, but in reality, this is a concurrent indicator, and you know, the higher readings come when the market's higher, and the lower readings come when the market's lower. So in that respect, you can almost call it a contrarian indicator. Like most contrarian indicators, it tends to give you a better signal in terms of picking a bottom than a top. You know, if you said back in the early 2000s there, oh, this indicator's high, therefore I'm going to turn bearish, you would have turned bearish back in 2004 and had a bad time. So it's an but it definitely is an interesting piece of context, and it would be again something like the previous charts, that you would be mindful of the signal, and you'd be looking for other things, perhaps more meaningful signals to line up with that. Number 5, quote unquote, but there's no earnings growth. And I've quipped there that I can't remember how many times I heard that in recent months. So let's look at the chart there. It's the year-on-year change in S&P 500 operating earnings growth, or earnings per share growth. And it's turned positive, which, yeah, not many people were expecting that. Probably not a whole lot to add to that chart. Being earnings per share, obviously it's going to be impacted by share count, but buybacks can't turn a negative earnings number positive. So, I mean, that would probably be my sort of key counter to that. I mean, you look at that there, it's had 4 replies. Basically, those are all people saying, yeah, but what about buybacks? And buybacks are probably, moving around the magnitude a little bit, but yeah, buybacks can't turn a negative earnings growth or negative earnings number positive. So there's obviously a positive earnings figure there somewhere under the hood. I'll probably go and have a look into that a little bit more later. But interesting, given the sentiment. Number 6, emerging markets continuing their decade-long relative bear market against the S&P 500. What's the odds the next decade is going to be more of the same? So yeah, I guess, trend is your friend. The trend there is not your friend if you are bullish on emerging markets versus S&P 500. Yeah, so if you look at the longer term version of this, which is something that I do pay a lot of attention to, I mean, my work is mostly involved in, most of my clients are asset allocators, and, definitely the emerging markets versus US or emerging markets versus developed markets is a pretty key long-term asset allocation call to make. And if you extend the chart backwards, you almost get a copy and paste of that, little bit different amplitude, but you basically copy and paste this price action here back for the previous kind of 20 years. And the point that I would sort of try to make with that is that you tend to have actually roughly 10-year cycles of relative under and outperformance, and you can kind of map that to a lot of other factors in the background. So obviously valuation has a very big role. EM were trading roughly on par with developed markets around this point here, around the peak. I think they might have managed to trade at a little premium during that period, versus normally they trade at a discount, and back when that period of outperformance started, they were trading at emerging markets were trading at quite a valuation discount to developed markets. So at this point, valuation, as you'd expect, emerging markets are now trading at quite a discount. And so, for longer term price calls, longer term allocations, valuation is really a key indicator. I'm not showing it, but I'm just making the point there. The other thing that maps to these cycles is like the US dollar. US dollar also tends to go through these sort of 10-year bull bear markets, and you can probably map it fairly closely to that. And the other one is growth differentials. Um, you know, you can almost, not quite, but you can kind of map the China GDP growth to this, which, if you take that as a proxy for emerging markets. And I used to keep track of that. You can actually map things like relative export growth of developed versus emerging markets to that as well. So these decade-long cycles tend to map fairly closely with valuations, macro, and currency. And it's the currency we can kind of have some feeling for, because you can look at valuation for currency as well, and the currency is slightly overvalued at the moment. So back to my kind of quip there, that what are the odds that the next decade is more of the same? Well, the odds are fairly low based on history, based on this tendency for emerging markets relative performance to go through circa 10-year cycles, long-term cycles of relative under outperformance. It would have to depart from the historical tendency, and it would have to depart from basically what valuations are pointing to for the next sort of 10 years. Now, could the start of that next 10-year cycle be delayed by a few years? Entirely possible. Entirely possible. So maybe you have to actually wait for it to turn first, which is, I think, probably what the point that All-Star Charts there we're kind of making there, is that, the trend for, if you're picking emerging markets, if you're picking a turn in that cycle, the trend is not yet your friend. Number 7, such a persistent and substantial performance gap will be enough to permanently change beliefs and narratives for a lot of people. Great chart there. Great chart from Jeff Winiger there. So let's look at it. What is it? It's the 10-year annualized performance differential between high PE stocks and low PE stocks. So when it's below the line there, basically it's the high PE stocks that are outperforming. And the sort of the theory and most of the practice is that lower PE stocks tend to outperform the higher PE stocks. And that's kind of the core thesis behind value investing, is that, low PE stocks are cheap, and, if you buy stuff that's cheap, typically, that's better than buying stuff that's expensive when it comes to the markets. And certainly the .com experience was a good example of that. And cyclically, when you get to the bottom of a bear market, valuations for the average stock tend to be very cheap. And at the top of a market cycle, at the end of a bull market, valuations tend to be very expensive. So that kind of reinforces the logic there from a cyclical or market cycle kind of standpoint. And if you look through history there, you do get cycles, but on average, low value, it's paid off to buy low valuation stocks rather than relative to high PE stocks. But we had another exception here in recent years, and it's been a kind of a multi-year exception, and it's actually gone beyond the .com peak. And what I kind of alluded to at the start there is that this kind of substantial exception or shift definitely is enough to highlight some trends, and certainly probably change some beliefs and narratives there. there's going to come a point probably where people will start to doubt whether this will actually ever mean revert. And probably some of the thinking behind that would be that, we're in the middle of a generational structural change, you know, with the rise of tech, the fall of old industries, disruption, I think is the kind of the buzzword. For example, a lot of the high PE stocks are, on things that have basically changed the way we do things, like Amazon, for example. You don't go to a bookstore anymore, or most people basically just, you might go into a bookstore to have a look, but you order it on Amazon, and it's not limited to books, so you can buy just about anything on Amazon, um, you know, and a lot of different things there. Netflix again, you don't go to movie theaters anymore, you just look on your TV on Netflix at home. I mean, those are just a couple of examples that people would point to on this. And so, as a result, you know, investors are not dumb. They see these trends, and they see the blue skies for those kind of businesses and price them up. And the ones that are the losers out of that get bidded down, trade on low valuations. It's kind of that narrative, I'd call it, or sort of explanation, backward-looking explanation, is that the low PE stocks are low for a reason. And then there's other industry aspects as well. So energy, for example, has been a big laggard. Energy underperforming, and I guess there's some reasoning behind that would be that energy is a sunset industry. Traditional energy is, renewables are going to be the way of the future. Maybe they are. I mean, there's kind of, I guess, two calls to make there. Is one, is it really going to be the way of the future? You've got to make this big guess about that. And two, is that industry, going to decline and disappear immediately, or is it going to take, another few decades, and therefore, the valuation aspects are overdone? Certainly something to think about, and I think a lot of people are thinking about this, and maybe it is just another cycle, and like emerging markets, we do get this turnaround there. You can kind of see that there in a way, from 61 there down in looks like early 70s there. You kind of have that downward trend, and then an upward trend, then a downward trend, and an upward trend, downward trend there, and it is following roughly about a 10-year cycle, 10 to 15-year cycle. So maybe the right way to look at this is simply that we're at the end of another 10 to 15-year cycle of relative outperformance of value versus growth, or expensive versus cheap. Number 8, interesting graph of S&P 500 direct revenue exposure to Greater China. So we've got here revenue percentage, percentage of revenue from China and Hong Kong by industry group. Yeah, 6.2 overall, and it varies a lot by sector. Obviously utilities is basically nothing, and semiconductors obviously a big proportion. There's a lot of indirect effects as well. If you get like some sort of disaster or slowdown in China, kind of like what we're going through. Yeah, just a bit of a infographic really. Next, number 9, outlook for traditional buy and hold portfolios. Going to either need to change your beliefs, manage expectations, or change your approach. So what it is here is the 12-year nominal annual total return on the conventional portfolio mix, which is what, 60-30-10, 60% equities, 30% treasuries, 10% cash. And the point of this chart is basically they're projecting, based on their methods here, that future, the next 10 years is going to be a low return experience, certainly lower relative to history. And yeah, so, and kind of what I was mentioning back in that tweet there is that as a result of this, you know, and by the way, if you look at various other measures, you probably actually come up with, like I've got my own capital market assumptions, and if I plug them in, it would probably be a fairly similar result. Obviously, it's going to be higher if you include some of those things like, overweighting emerging markets, global equities, value stocks, things that are, because, a big reason why you have low expected returns for equities is because of high current valuations for US equities. And treasuries, well, there's not really much escaping treasuries. Yields are low, and if you assume buy and hold, you're not going to be able to do much better than the current couple of percentage points there, and you're probably not going to actually do much better going globally, especially if you go to those countries where yields are negative. So again, back to what I mentioned there, you need to change your approach. So putting different things in the asset allocation, or change your beliefs. So maybe actually this time's different because something else is going to happen that's going to make it returns go much higher and nicer than that. That's some sort of unforecastable thing maybe. Or just manage expectations that, hey, returns aren't actually going to be as good as they were in the past. Last chart, number 10 here, number of listed companies in the US versus number of US equity investment funds. Kind of speaks for itself there, and it's a pretty interesting chart. Back in the early 90s, the number of listed companies outnumbered the number of US equity investment funds by 6 to 1. At the moment, it's 1 to 1. So back then, for every one fund that you had, there were 6 different stocks. But now, for every fund you have, there is 1 stock. So you've basically got more funds chasing fewer stocks, which, it's interesting from a supply and demand standpoint. There's obviously a lot of other things going on behind this fall here in the number of listed companies, which I've got a link there, which I did actually go into that a little bit, but I won't go into that now. I'll wrap it up at this point. There's not really any short-term tactical takeaways this week. We've just come out of a sentiment kind of shock. Actually, if we jump into the weekly survey, the preliminary results here, sentiment's kind of rebounded a bit this week in the last couple of weeks in the weekly survey, and typically that's been a good signal of a bottom, but then back in just before that crash in late 2018, sentiment did fall, then rebounded, but just chopped around for a bit before you had that last fall. But that is actually the typical playbook there. So you get this big crash in sentiment, then you get a rebound, and that ends up being the market bottom. Relatively small crash though this time around, or sell-off really. But yeah, I will leave it at that. If you've got any comments, feedback or requests for next week, put them in the comments section below, or at me on Twitter there at Callum_Thomas.